Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. All right, let's bring on our next guest. We love talking to Danielle DiMartino Booth, Chief Strategist and CEO at QI Intelligence. Danielle, we've now had some time, a weekend or so, to kind of digest what we've heard from various central bankers around the world. I'm sure you've had a chance to kind of coalesce a viewpoint. Anything change for you? What are you really thinking about where these central banks are going, where rates are going, based upon what we learned from some of them last week?
Well, I think at a very minimum, you need to think of rates as going nowhere.
Okay.
And I say that as a minimum. We've only got a 20% probability of a rate hike for the September the 20th meeting. But, this is a big week for payroll data. So, more strength in that area, even if it's very lagged in nature, even if we're seeing massive revisions come out of the Bureau of Labor Statistics. Their birth death adjustment showed a negative 816,000 revision downward in the 3 quarters ended December 31st, 2022. Even though the data seems to be catching up with reality, it's pretty apparent to me, at least, that Jay Powell is looking at backward-looking data for reasons to justify higher for longer. I think that is the goal, and I think that he's going to look for whatever data he can find to justify pressing forward with another rate hike, or, again, at a minimum, staying higher for longer, continuing to run that balance sheet down.
Danielle, this is Simone here in New York. Good morning to you. You talk about this meeting reality, the Fed meeting reality, and how the yellow trucking shutdown may herald the beginning of a sort of bankruptcy cycle. How do you see this playing out? What kind of timeline would you anticipate for seeing more bankruptcies? And then when can kind of the Fed no longer ignore that?
That's a fabulous question because, if you look at BCY Go on the terminal, you'll see that the march of bankruptcies really has not subsided. We're continuing to see bankruptcies roll in at the fastest pace since 2009. I think what the Fed has to take into account, though, right now is headline risk. You kind of had a series of quarters where Silicon Valley was coming out with very splashy headlines, 10,000 here, 10,000 there. And then that kind of went dormant for a while. We really haven't seen headline risk in layoffs announcements. But I think that we're going to see that increasingly going forward, whether you're talking to Chris Williamson over at Standard & Poor's, who is saying that, if manufacturing backlogs remain in contraction as they've had now for 15 straight months, that you're going to start to see manufacturers that are not benefiting from the Inflation Reduction Act, that are not building green new factories. You're going to see layoffs start to come through. And that's exactly what Chris Williamson warned about in the second quarter earnings season. Remember, we're only at the halfway point in this earnings season, and you've got this great big splashy 30,000 people losing their jobs because it looks like this is going to be a Chapter 7 filing straight to liquidation as opposed to a Chapter 11 restructuring. This is going to capture a lot of Americans' attention.
So we're going to have a ton of economic data this week, Danielle. You and your team are going to be very busy. Obviously, the non-farm payroll will be a big data point. I guess I'm looking around the world. I'm seeing, some recessions around the world. I guess Germany just had a flatline quarter after a couple of quarters of contraction. Are you concerned? What is your level of concern about this U.S. economy here?
Well, the U.S. economy cannot claim to exist on an island. There was a very slight uptick in Chinese official manufacturing data overnight, but that remained in contraction. I think the more notable development out of China, given that we had such great hopes for this reopening trade, is more so that we're seeing a downward movement in the services components of these PMI numbers. And that, I think, was what people paid closer attention to overnight. If it's not going to be the industrial sector out of China, then what's going to happen if the services side is slowing down? Specifically, that services one dropped to 51.5. So you're kind of on the edge of contraction in the second largest economy. And as you just pointed out, Germany is really 3 quarters into recession, we saw that the first quarter in Germany ended up being revised downward into contraction. We could see a similar bit of data coming out of Germany that revises the second quarter into contraction as well. The United States cannot isolate itself from the globality of the current recession.
Yeah, but I mean, to that end, though, the United States has existed a little bit apart from China for several years now, considering how slowly China has come back in the game post-pandemic. And the U.S. consumer remains strong. I mean, do you think that the U.S. consumer can potentially continue to kind of power through some of this growth and offset some of the woes that we hear from around the world, despite this level of rising interest rates?
You know, it's interesting you raise that question. Outside of the employee retention credit, which we know, I think, pumped in about $33 billion into the U.S. economy, we know much of this is fraudulent. Outside of that fiscal area of massive support going to some of the wealthier Americans, we're seeing a big uptick in the number of student loan borrowers who are preemptively getting out in front of what they know to be resumed student loan payments. And that's going to have a crimping effect on U.S. consumption. And we are indeed beginning to see that. So people are getting ahead of interest accrual beginning on September the 1st, actual payments beginning on October the 1st. I don't see an offset to that in terms of layoffs decreasing, in terms of hiring increasing. We're just not seeing enough evidence to show that there's any upward momentum going forward for the U.S. consumer.
All right, so I'm going back and I'm looking at this eco screen on the Bloomberg terminal. It is literally 2 screens full of data we're going to get this week. Danielle, can you help me focus on what I need to focus on? If there's a data point out there that you're really going to pay attention to this week?
So I'm going to be looking a lot in terms of hours worked. And that really is a gauge of how tightly employees are holding on to their employers are holding on to their employees. If they're cutting back hours aggressively, trying to not push through with cutting headcount to cut costs, that's something we pay very close attention to. And again, we had Chicago PMI just out a few minutes ago. That showed that backlogs remain in contraction. I'll be looking for a similar echo out of the Dallas Fed manufacturing that hits at 1/2 this hour. We focus at QI Research so closely on backlogs because that is a gauge of future demand. If the demand is not there, if unfilled orders are not there and in fact contracting, that means that your need for employees is decreasing as a factor of time.
All right, Danielle, thank you very much. Always appreciate getting a couple of minutes of your time. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Busy economic week this week.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Still got a ton of earnings, so when we get to earnings, we like to talk to smart people. When we can find them, we just dial BIGO on the terminal. That gets you Bloomberg Intelligence, 400 research analysts around the world covering 2,000 companies, 130 industries.
And what they do is really incredible. They take you through from the beginning to the end of how these stories for these different companies.
Yeah, I don't know who started that business, but that person must be a genius. Here, anyway, let's bring in a couple of those smart ones. Mandeep Singh, he covers the tech stuff for Bloomberg Intelligence, and Poonam Goyal covers all the retail. And we're going to tie that in because retail and technology, they have collided. Think Amazon.com. All right, so Mandeep, I want to start off with, and we'll let you, I know this is news on Pat Palantir. I'm going to talk about Apple. What do I need to pay attention to from Apple's when they report numbers after the close Thursday?
Unit shipments when it comes to smartphones as well as your tablets and Macs. And look, I think expectations are low. Unlike some of the other tech companies, Apple's estimates have gone down. So in terms of expectations, they are low. I do think they're probably going to print an inline quarter, but in terms of guide, you have the iPhone 15 coming up. That is where the focus is, the holiday quarter. What could it do?
I think I might upgrade to the 15. Anurag's pushing it. Anurag Rana, another one of your tech flunkies over there at Bloomberg Intelligence, he's telling me that's a meaningful upgrade.
It is, but I guess in the context of what's going on in the tech world, the generative AI buzz,
Oh boy, here we go.
it's not going to be that big of an upgrade in terms of what the phone can do. And everyone is excited about potentially upgrading the hardware for running these large language models on your phone. I don't think the iPhone 15
I have no
is going
interest
to
in
do
doing
it.
that. All right.
I mean, I'm interested, is this part of the overall weakness that we have seen in PC demand? Is it just that your PCs last longer, or is it somehow about penny pinching and a broader consumer story at this point with Apple?
I think there was kind of certain cadence to refresh cycle for both PCs and smartphones that hasn't changed. Every time you have a big upgrade to hardware is when you have a new technology coming up. And I think whether it's linking your headset or being able to run generative AI on your phone, these are the type of things that can drive people to, upgrade their phones, the ones that are on the fence. Oh, my device is good enough. Do I really need a new one? And that's what drives the ASPs. So right now, everyone is talking about, even though the unit shipments is flat, how will Apple keep growing? It's the services and the ASPs, because the next version of the phones continues to get expensive and they keep layering more services.
All right, Poonam, we've got a lot of retailers set to report in the coming weeks, but let's start with Amazon. What do you expect the story to be from Amazon?
Sure, Paul. I think it's going to be a mixed read. So we're going to see some strength online with sales growing, or I should say GMV growing in the high single-digit range, which is a good thing because since the pandemic, Amazon has dealt with having to see more moderated sales growth, and coming back to the high single-digit, low double-digit range just puts it on track to go back to the double-digit gains that we've been used to seeing in online. But outside of that, the focus is also on AWS. And AWS sales will slow in the quarter. They're only expected to grow at a high single-digit pace, and they could even moderate further in 3Q when we see their guidance, which could probably be closer to 7%.
How much does AWS just simply outweigh, however successful or not Prime Day was and the various shopping trends that we're seeing?
Yeah, so Prime Day was a huge success. We heard from Amazon the first day was its largest sales day ever. It even outpaced Black Friday and Cyber Monday last year. But when it comes to AWS, the reason AWS is so important, because it is the cash cow for Amazon, right? They produce pretty much all or nearly all of Amazon's profits. So it's really important to see those profit numbers rise. In the quarter, Amazon's AWS business will only yield about a 24% profit margin. It has historically been near 30%. We do see it coming back to that and even outpacing that as we move forward in the next few years. But for now, as that profit dwindles a little, it will pressure the overall profitability.
Mandeep, AI is certainly story number one in your world in technology. Another name today that seems to be getting the AI kind of tap on the shoulders, Palantir. What's going on there? What is Palantir, and why is it up 11% today?
So with all the talk around generative AI, and Microsoft is the only one that has launched a tangible product around it. They're charging $30 Copilot.
Chat GPT.
Well, and also they're charging $30 for their copilots. This is the enterprise version of the product. ChatGPT is more consumer facing. So to me, all these companies, whether it's Palantir, Snowflake, Databricks, what they're doing is essentially ingesting these large amounts of data that is being created and trying to use, generative AI or large language models to make the AI better. And that is what the play is. Now, whether or not they're successful in monetizing it, we don't know, because they haven't launched a product like Microsoft has. So that is the key. If anytime you see a company actually launching a product, being able to sell their customers, that's when this is a new deal. And that's, I think, the only tangible revenue you see right now is for Microsoft. Yes, it's further out, but at least they have a product out there. They're looking to monetize it. With Palantir, you've seen multiple expansion. Yes, this is a company that is built around data visualization and potentially could use generative AI, but we don't know if they have a product they'll be able to monetize.
But that gets an 11% move in the stock?
And that's where, everything that has happened this year is multiple expansion, no uptick in estimates. So come earnings, the expectations are sky high, And that's where you got to deliver like NVIDIA has,
Yep. That's what Doug Cass from Seabreeze Partners was saying to Tom Keene and I. And he's gotten increasingly bearish as the year's gone on because it's all multiple expansion. He hasn't seen the earnings yet. The first half of the year, okay, he kind of understands. The most recent, 4, 5, 6 weeks, he just doesn't get. Right. So that makes kind of some sense.
It's people looking for the long-term growth that we're not going to necessarily see immediately. But Poonam, I want to throw this to you as well, because I know you cover lots of these consumer and e-commerce companies. One of the things that we've been trying to parse here on the AI story is, do we see some of these AI upgrades roll out, for consumer benefit, for, tailoring ads that get to consumers, for getting the right products in front of them, or do we just simply see efficiency on the back end? What are you seeing from some of the brands that you cover? Because I know there are quite the lengthy list that report this week that may throw in that mention of AI in their earnings calls.
Sure. I think AI is both. It definitely will drive efficiencies on the back end, but we are seeing companies also bring it to the benefit of the consumers and the sellers. A recent example, eBay reported last week, and they launched a listing program where you can take a picture of a product that you want to sell, and AI will generate the description for you. So it removes a pain point or a friction point in the selling process, and also allows you to amplify your listings online. So we think that's one use case. We have Revolve reporting this week. They've used AI to help generate marketing billboards. They're using AI to help improve search. So I think there's a lot happening with AI, notably generative AI, that's really going to drive the ROI for both the buyers and the sellers.
Real quick, Mandeep, I want to talk to you about advanced micro devices. It's a chip maker. Can it be a NVIDIA kind of like play?
I mean, last week we learned from Intel that PC market seems to be bottoming out in terms of inventory correction. So that's a positive sign. And look, bulk of AMD's revenue is still tied to CPUs. Okay. Now, what's going on with generative AI is there is a substitution phenomenon. Things that you were able to do with CPUs before, right now you're looking to do with GPUs, because that's where the generative AI connection comes into play. So I do think eventually you're going to find that these companies either have to diversify their CPU kind of footprint and produce these accelerators, or I think they will be a tale of two stories, that one part is growing and the other part is declining.
All right, we'll keep an eye on all that. More earnings coming up this week and probably going into next week as well. Mandeep Singh, Poonam Goyal, they're two of the best analysts at Bloomberg Intelligence, one covering tech, one covering retail. But guess what? It's all converging.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk the salad business. I'm not a big salad eater. Simone,
I love salads.
You like a good salad.
And I particularly like salads at lunch, which is something I think our next...
All I know is, the people here come around lunchtime, they come in and out, and they're all carrying these bags from Sweetgreen, which I guessed at the time was a salad thing. Again, not being a salad person, I don't know. But it is definitely a thing across the street from the Bloomberg HQ here at Midtown Manhattan, and I know it is around the country as well. Jonathan Neiman joins us. He's the CEO and founder of Sweetgreen. And Sweetgreen trades on the New York Stock Exchange. The symbol's SG. You can put that into your Bloomberg terminal. Jonathan, thanks so much for joining us here. I know you guys reported earnings last week, missed a little bit on revs and on EPS. Stock traded down. Tell us about the most recent quarter. Tell us about the guidance you're giving your investors.
Absolutely. Good morning, everyone. So we're really proud of the quarter we posted. We had 22% year over year growth, 3% comps with positive traffic, and we expanded our restaurant level margin above 20%, delivering our first profitable quarter on an adjusted EBITDA perspective as a public company. So I think a sign of more things to come. Companies focused on disciplined, capital efficient growth as we continue to bring our mission across the country to more cities and more locations. And we're looking forward to continuing driving some comp drivers we have around our loyalty program as well as our expanded menu.
Well, Jonathan, Piper Sandler was out today with a note talking about how the tide may be turning here a bit for Sweetgreen after a tough sledding since going public. And I think it's pretty obvious going public November 2021, right post-pandemic, then seeing the wave of Omicron has to be hard for any company that does a lot of office business. Do you see the tide as turning? What things are you telling investors, hey, wait for this, because in a quarter, 2 quarters, we're really going to be able to start delivering on some of those expectations?
Yeah, we're focused on a few big things. One is continuing to expand our footprint, and not only opening our classic stores, but a few new formats that we've opened that have been really interesting and successful. One being our drive-through format called the Sweet Lane, another being our Infinite Kitchen. We've also been, I hear you guys talk about, not being a salad guy. While Sweetgreen started as a salad company, we're much more than that today. Really consider ourselves healthy comfort food. And our warm bowls, we sell more warm bowls than we do salads. We're on a journey to continue to expand our menu and taking the type of sourcing and fresh prep that we do, but expanding it beyond just salads. And so things with, leaning on protein and carbs and just heartier, craveable items to really bring our mission to life. As I mentioned, we've also been focused on a loyalty program. We call it Sweet Pass. It has 2 components, both the free rewards and challenges, as well as a membership program where for $10 a month, you get $3 off every day. And so a number of comp drivers built into the business as we look forward, all while bringing a cost discipline approach and making this company profitable.
Yeah, talk to me about Infinite Kitchen. You mentioned this there. This is the sort of automated version of your kitchen. You've rolled out one of them that I believe, and correct me if I'm wrong here, eliminates employees. You put together these bowls without employees there. What's your vision for the scale of this, for the timeline, with respect to getting this in more than just kind of a handful of stores?
Automation is something that I'm personally very excited about, and it's something that Sweetgreen has been working on for a number of years, developing this technology in-house. And so what we see is we believe that we will always still make the food in-house, but with this automation, we're able to assemble the bowls in a precise manner at much higher throughput. So the Infinite Kitchen can make 400 to 500 bowls per hour, perfectly portioned, perfectly accurate, with a very high quality experience, both for our team members and our consumers. So people are loving the pilot store that we have. We're opening a second Infinite Kitchen restaurant later this year in Huntington Beach, California, and have plans to begin integrating this technology into restaurants next year. We do believe over time, a huge portion of our fleet will integrate this technology, but we still have a lot to learn in terms of exactly how to deploy it. But all to say, a very promising start with this technology.
Jonathan, talk to me, again, not being that familiar with your restaurants, although I am going to go today for the first time because it's on 61st Street, I think, in Lex, so I'll give that a shot. Where have you historically located your stores, and and how has that changed maybe since the pandemic and the different ways people work and the amount of time they spend in the office versus home?
Yeah, absolutely. So we started the company in Washington, D.C., almost 16 years to the day. 3 kids in Georgetown, really had nowhere to eat. So we started in DC, we worked our way up the Eastern Corridor. And for the first, call it decade of the company's history, we were very urban leaning, although, we did have suburban stores as well. Ever since the pandemic, with the dispersion of consumers, as well as following our customers home, we've begun to explore more suburban. And so our pipeline has leaned heavily suburban to a number of new markets over the past few years, where our fleet today is approximately 50% urban, 50% suburban, and we see pretty much equal success in both worlds. So similar AUV, similar margins, which really is talks a lot about the portability of the brand, not only in different type of trade areas, but in different markets all over the country.
Does that capture a different kind of consumer when you move outside those typically urban areas? And then also, with respect to the consumer, are you worried about the restart of student loan payments weighing on your customers' wallets?
So we are expanding. We're continuing to expand our consumer. So looking to capture more families, different age groups, and really be relevant for anyone looking for a craveable, delicious, and healthy meal. So over time, our vision is to redefine fast food and really bring this idea of healthy comfort food to scale and kind of see everyone as being our consumer over time. In terms of the health of the consumer, we see a lot of health in our consumer today. We haven't seen any reason to be concerned. It is something we're of course watching, understanding the student debt repayments. But given the 22% year over year growth and the positive comp and positive traffic, we are overall feeling very good about the trajectory.
All right, Jonathan, thanks so much for taking some time to chat with us. Jonathan Neiman, he's the CEO and co-founder of Sweetgreen. That is a publicly traded company. You can type in the ticker SG into your Bloomberg professional terminal and get all the data you need on that company. I think I'm going to go there today. It'll be my first time.
Are you going to, is you going there going to add to the 12% gain that we're seeing in the shares of Sweetgreen today?
Maybe, and maybe it's going to help.
What's Paul going to put in his? I think Paul eating a salad, he defeats the purpose.
I think you're right.
He's going to put fried chicken in it, etc.
Sure. All right, we'll see how it goes. I'll report back.
You're listening to The Tape, Kantar Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
So let's talk beer. Let's talk Heineken. And we do that. We talk to Duncan Fox, research analyst of Bloomberg Intelligence. You can tell via Zoom from the phenomenal Bloomberg European headquarters at Queen Victoria Street in London. An absolutely phenomenal building right in the city of London, right by the Bank of England. Thank you very much, Mike. We appreciate those digs over there. Duncan, talk to us about Heineken. What did we hear from our good friends in Amsterdam?
It was a little bit of a surprise today, actually, in that they actually downgraded expectations. That's something that our friends at Heineken don't do very often. So they've basically been investing a lot more behind their brands, and there was a couple of markets which really had some poor volume, which were mainly Vietnam and Nigeria. And so they've decided to keep their investment high in those markets and take the hit on operating profit, which, from my point of view as an analyst for the long term, absolutely the right thing to do. But it was a bit of a shock this morning at 6 o'clock. So shares are down 7% or so, or they were the last time I looked.
Yeah, hard to go out, despite being in Europe, hard to go out and get a beer at 6 a.m. when the earnings come in as a surprise. Talk to me about, so a lot of this, I understand, is they've invested heavily in these smaller, more local-oriented operations, but there is where the consumers are feeling maybe the pinch. Is it because they kind of can't continue to add these price increases on as supply prices increase? Or explain to me how this brews down.
Nice one. Yeah, basically they push prices up about 12% on average, which is pretty high. But you have to remember that their costs went up mid-teens in Q1. They're going to go up low teens in Q2. So what they've done is effectively take the pricing up front. And occasionally in some markets they just went a bit too far as the economy's slowed. So the consumer has however much money they've got to spend, and beer is not an essential, or as much as I'd like it to be. So they've traded down, I think, in some markets to cheaper brands. So they've got the right long-term strategy for sure. The markets that I mentioned, Vietnam and Nigeria, they have huge populations, great economic growth in the long term. They've just had some short-term issues that have caused them some volume decline in the short term. But they've taken the decision to look long term, which I think is the right decision, and sort of take the volume, the profit hit this year. So it makes sense to me, but
right.
No
so
one was expecting that first thing. I'm
looking at the PGEO function on the Bloomberg terminal that gives you a financial analysis, and you can see by segment where these guys are, and by geography, 40% of their revenues comes from Europe. About 33% from Americas, and then Asia's the next biggest, and then EMEA. So are they investing in, I guess, where are really the key growth markets for them that you talk about their investment?
Well, ironically, Brazil is one that they've pushed quite a lot of money into in the last couple of years. They bought Kirin's business probably about 4 or 5 years ago now, and they've been transferring that to make sure they have Amstel and Heineken beer going through that network. They're gaining market share, but obviously it's not showing through in operating profits because of that investment. You've then got Mexico as a big market, Vietnam, China are the big markets. So all of those have got very, very big populations with, more importantly, big young urban populations, and that's what you want as a beer manufacturer, then you can tailor your investment to actually get long-term growth. So it all makes sense, but every now and again you come up with a shock because economic growth has slowed down. Vietnam, just for some reason, the economy just stalled after the Chinese New Year. There was some overstocking that they put in place during Chinese New Year after pushing prices up dramatically. They had 43% volume growth in Vietnam last year, and I think they were expecting something similar, and I think they just got caught out a little bit when they pushed prices a bit too high.
Duncan, just let's step back and just look at the global beer market. You know, when you talk to the big brewers that you cover, how do they think about just kind of global growth for this category?
They would expect something low volume growth, but it's really about premiumizing your brand portfolio. So you get very good pricing and mix. That's where their strategies are. Problem with that is when you've got economic growth faltering, you take it on the chin in the short term, and you've just got to keep investing behind those brands to try and get us to buy the premium beer. So it's all about that, all about getting into the markets where you've got young urban populations. So emerging markets are where the growth's going to be, and then making as much money as you can from your core home markets, which are more likely in developed markets like the US or Europe, as you mentioned earlier for Heineken. So Heineken's investment has been getting outside of Europe basically and reducing that geo split to 40%. It was well over, well, it was probably 60% of about 10 years ago. So they've done a very good job at pushing the portfolio into the right areas.
Speaking about those core markets, North America and Europe, is the beer drinker or spirits drinker perhaps more broadly, are they healthier in one versus the other? What is some of the commentary that you're hearing from these brands that span both markets telling you?
Well, certainly up until recently, the spirits market was doing very, very well. Experiences, you probably heard my colleague Deborah Aiken talk about those, are very, very key for the young consumer at the moment, and the spirits companies have been extremely good at fueling that. If you look at all of the marketing campaigns that the spirit companies do, it's around events, so they hire bars and do something around a brand, and that's been very, very successful. Beer companies have yet really to go down that route, although they are now putting money into e-commerce to make sure that they can get more of that spend, I suppose, and more of the consumers doing it. So the beer companies, I think, have got to catch up a little bit. All in all, they both get a volume growth in the sort of low single digit if you strip out the COVID anomalies that we've had over the last few years. So it's going to be very interesting how the results go the rest of this week. Diageo tomorrow and ABI later in the week, and let's see where their volume growth are. We know there's been some slight overstocking in the trade as we've gone through all that COVID anomalies. So it's going to be a very interesting set of results.
So Duncan, I know you're a top level analyst. You like to do a lot of primary research. So you're in your favorite pub in London. What's a pint of your favorite beer cost you today?
Too much would be my response to that, but you're looking at probably somewhere around between £6 and £7 a pint.
That is
so what's that?
Wow.
It's not cheap. My favourite pub though is where I live, and I live in Dorset now, and it's a little bit better there. It's probably around about £3.50 a pint. So living out in the country really helps.
That's very good. All right. Well, you're right down there in the city of London, where all the big hitters are in London. You can afford to pay a little bit more. Duncan Fox doing that primary research that he's known for. He covers all the consumer products over there in Europe for Bloomberg Intelligence.
$6-7 a pint. I mean, when you take this in dollar terms.
Oh yeah. It's exactly. I mean, I remember back when I went to. I think this is a correct memory. Putting down a pound coin, which by the way is still the best coin on the planet. The pound coin, the 1 British pound. That would get you a beer back in 1987 in London. So I don't know. So that's inflation. That's inflation you can take home with. All right, that was Duncan Fox talking beer.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Simone and Paul. We've been around all morning, and we're here for another 20 minutes or so. Really interested in our next guest in part because of the name, which is Shark Ninja. Mark Rosenzweig is CEO of Shark Ninja, and they just rang the New York Stock Exchange bell this morning, publicly traded, and they've been through a little bit of an interesting corporate history. So this is the maker both of those Shark vacuums and Ninja blenders. They were a part of a Hong Kong listed company, apropos of our previous conversation, but now they have gone public and shares through a spin out here. So Mark, I want to bring you on as well. Looks like shares jumping higher in New York after this spin-off today. Talk me through why go it alone, why spin out from JS Global?
Yeah, well, thanks for having me. Look, Shark Ninja has a great story to tell, and we believe that it's the right place to tell that story is the New York Stock Exchange. Shark Ninja goes to market under two really well-respected brands, as you mentioned, the Shark brand, which is a market leader in cleaning, home environment, and beauty, and the Ninja brand, which does just about everything in the kitchen and has now gone outside with our outdoor cooking appliances. We have a story of scale, nearly $4 billion of revenue. We have a story of profitability. The business is highly profitable. And we have a story of growth and a demonstrated track record of organic growth. You know, we were a business back in 2008 that was less than $200 million in revenue. Today, nearly $4 billion. You know, all of that has been organic. We've never acquired a dollar of revenue in the company's history. And so we really believe that, the right place for us is to be a standalone business on the New York Stock Exchange.
Now, it's my impression you were the largest part of JS Global, or Shark Ninja was the largest part of JS Global. How did it come about that you guys went your separate ways?
Well, Shark Ninja was owned by my partner, Mark, and I up until 2017 when we sold the majority stake in the business. We really wanted to bring a partner in to help globalize the business. 5.5 years later, the business has more than doubled in size. We have a fast approaching $1 billion business outside of North America. Our customers, our consumers, are here in the United States. The United States is the largest market for us. We're based in Boston. We have a team of almost 1,000 folks just outside of Boston. And so we really felt like being a subsidiary of a Hong Kong listed company wasn't the right place to tell the story.
All right. So for your company, and I'm not familiar with your company, I have to admit, talk to us about kind of your distribution model and kind of how that's evolved.
Yeah. So the distribution model is that, we sell to every major retailer in North America, in Europe. We have a very strong .com business. Our brands are the most searched brands in our categories on Amazon. And we have a really healthy direct-to-consumer business. So our distribution model has really been based on the idea that we want to be relevant where the consumer chooses to shop for our products. If that happens to be in a retail store, great. If it happens to be direct to consumer or go online. But that really is kind of how the model is, not just in the US, but really in every market that we sell.
Mark, talk to us about the decision to spin off as opposed to perhaps an IPO. How did that play out?
Well, when we made the decision to spin out and be a publicly listed company, that was going back a number of months ago. And at the time, the IPO market in the US was quite challenged. And so, we really wanted certainty to become a US public company. And this gave us the most certainty to be able to do that. We think we have a great story. We think when investors hear the story, many of these investors are already consumers of ours. I mean, our products are loved, in millions and millions of homes across America. Investors will respond, and we will become a company of interest, for investors on the New York Stock Exchange.
Talk to me about what you're seeing from consumers at the moment. There has been some shift away from consumer discretionary products because consumers are feeling a pinch in their wallets. Are you seeing that, or are you seeing consumers switch to different kinds of products?
Look, I mean, we're obviously, concerned for consumers and the inflationary challenges that they've had over the course of the last few years. We believe that Shark Ninja delivers incredible performance, high quality and reliable products, and we do it at an extraordinary value to the consumer. We're not the highest priced products in the market. We're not the lowest price. But we think that when the consumer buys a Shark or Ninja product, they're really, getting extraordinary value. And I think that when you read consumer reviews of what people write about Shark and Ninja products, you'll see that coming through in those reviews. So, we're a business that's grown 14 out of the last 15 years. We had strong growth in our first quarter. So we believe that if we can continue to give exciting innovation to consumers that solve their problems and continue to do it at a great value, that the consumer will respond.
Mark, what are the growth drivers over the next year to two for you guys?
So for us, it's the same growth drivers that have been really in the business over the last 8 years. We've developed 3 strong pillars of organic growth, and that's the important word there, organic. The first is, gaining share in the existing categories that we participate in. We're in big, definable categories, and Shark Ninja has a demonstrated track record of being able to gain share in those categories. The second is expanding into new and adjacent product categories. We've expanded into 10 new categories just over the last 3 years. Categories like beauty with our Shark Flex Style hair dryer. Categories like outdoor cooking with our Ninja Woodfire grill. And the third is international expansion. I mentioned earlier that we are fast approaching $1 billion in revenue outside of North America. So there's real scale in our international business, but there's still tremendous opportunity. I mean, Shark Ninja sells in 25 countries around the world. We sell in 27 different product categories. We believe that there's more product categories for us to enter into, and we believe there's more markets for us to expand into. So that's really, driving those pillars of growth.
Okay.
Is what we're focused on.
Excellent. Mark, thanks so much for joining us. We appreciate it. Mark Baraka, CEO and President of Shark Ninja.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.